This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
If they're not going to go to a broker and they're willing to work with you, you have to have something for them to trade into. And so what we created was a transformational exit strategy, which basically is a 45-minute meeting with a property owner to say, what are your goals? What are you trying to accomplish? Because I hear a lot, Logan, I'm managing this thing. I'm 65 years old. I'm managing this thing. It's the last thing I'm doing, but I'm a grandpa or I'm a grandma now, and I'd like to spend more time with my grandkids or this. And so you have to really understand what their goals are.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. In tight real estate markets like the one we have today, finding off-market deals is certainly a challenge for many commercial buyers. However, like everything else in this business, it comes down to building those relationships and presenting value to brokers, to buyers, and to vendors that'll basically give you a leg up and help you find those deals in these different markets. Now, today's guest knows all about this. He made his way as an NFL player to become a real estate investor and broker who really found his niche as an investment property specialist. Now, to do this, he had to really adjust his approach when it came to real estate networking and applying the hustle he learned as a professional athlete to find these off-market deals. And to make this transformation from athlete to multifamily specialist took a great deal of grit and determination. Now today, as the founder of Live Free Investments, his group focuses on joint venture and equity partnerships to help people become financially free with real estate. Now with all that, I'd like to welcome Logan Freeman to the show. Logan, buddy, thanks for coming on, man.
Augustino, thanks for having me. I'm excited to be here today.
Yes. It's good to have you on again. Now, guys, if I got Logan has to say, you can reach him via the contact page at livefreeinvestments.com. Okay, Logan, go ahead and tell listeners a little bit about your journey.
Absolutely. So grew up really identifying as an athlete in the capital of Missouri. So probably not a lot of listeners know, but that's Jefferson City, Missouri. And my mom really embedded kind of the work ethic in me. She worked 2 jobs. She really showed me kind of, earning a dollar and valuing that dollar. And long story short, I got my first job when I was 14 years old. And, I was starting high school at the time. So, the personal finance that I had available to me was Dave Ramsey, right? So what do? Well, you take that money that you make and you go put it in a Roth IRA. So when I was 15 years old, I started my first Roth IRA and started putting money into that. Needless to say, along my journey of going and playing collegiate athlete, briefly in the NFL, getting cut, my eyes were open to other possibilities, right? And I had some incredible mentors in my life that really helped me understand that, look, the mainstream media and the approach that they take is not what the 1% of the 1% really do. You need to find other passive income sources. You need to be a business owner. You need to be an investor. And so not only was I reading the books that kind of said these things, Rich Dad, Poor Dad, everybody knows the books, but I had mentors in my life living this out in practicality. And so, being able to read the books and have the theory and then see it effective at the applied level allowed me to kind of transition my life after football into real estate investing. And that's kind of where we're at here today. So when I was cut from the NFL, I went back and I finished my master's degree and I got a job making 265 cold calls per day. And just because I had no business experience, right? And so I had to pay rent. And so, because I didn't have a scholarship anymore. And so I did that. And I turned my car to the classroom on wheels. And that's when the light bulb moment went off for me. And that's when I started to hear all these different mentors kind of pouring into me in my life. The podcast back in the 8 or 9 years ago, were not what they are today. So you had John Lee Dumas with The Entrepreneur on Fire. You had, Lewis Howes at the School of Greatness, and you might hear, Kiyosaki on one of these podcasts back in the day. And so, the light bulb went off for me, and I knew that I wanted to get in real estate, but it took me some time. I moved to Kansas City. I had a W-2 job, and I had 2 different jobs, and I really found out that after my 3rd job that I was unemployable. So I was fired from my job 5 years ago. And when I was fired, I had the opportunity to step in as kind of a head of acquisitions for a $50 million fund here in Kansas City. They were buying single-family homes back in 17 and 18, 7 days, cash, and doing the whole buy, renovate, rent it out, and refinance model, but at scale. So I helped those guys across 265 homes return 88% of the capital to their investors and still cash flowed. And we did a CoreVest portfolio refinance. So that's a non-recourse loan option from the government, which was awesome at the time. And when I finished that fund, I really had to sit down with those sponsors and I said, where did the money come from? And that's when they said, Logan, it was a syndicated equity deal. And I didn't know what that meant. So went back into the education, moved my license to a commercial and multifamily brokerage, started to learn really everything about multifamily, bought a couple properties myself, quickly found out that I needed a team. And this is back when I, was just myself, solopreneur, just kind of going at it and try to find deals myself and finance them myself, run the deals myself, all these things. I ran out of capital, ran out of experience. And so I found some business partners. And now Live Free Investments is my holding company to what is now FTW Investments. And FTW Investments is about a 24-person private equity firm based out of Kansas City, Missouri. We've got about 1,300 units across 4 states, and we're venturing into new asset classes like shopping centers, mobile home communities, and development like we talked before the recording. So that's kind of where we're at today. That's my transition into the space.
It's funny that the Dave Ramsey talk, the work 40 hours, set money aside in your bank account, all that stuff. So many people that have been on this show, and myself included, we're all taught that's how you need to live.
Right.
And it's mainly that education that, that unfortunately our parents or the people around us at that time told us. And it's kind of funny. That's not how you do it. That's absolutely not how you do it. And it's like, you and I both know investing is how the rich become rich. That's how it happens. That's how it happens. And so it's like it's good that we get to share this message with thousands of people who are listening right now.
Yeah, if I could, one book that really helped me outside of this was MJ DeMarco's book, The Millionaire's Fast Lane. He really takes all of the dogmas from the mainstream media and breaks them down and says, guys, you really got to start thinking about this differently. He's not really a real estate investor necessarily. It's more on the business side, but it really helped me understand, okay, in the quadrant of employee, self-employed, business owner, and investor, you got to get to that investor piece very, very quickly or as fast as possible. The great thing about real estate is you can build a business around it and be a business owner while you are investing. And so you kind of get to take 2 birds with 1 stone at the same time. And that's why it really kind of hit home for me was that is the foundational kind of cornerstone that we want to build our family office off of, right? And after I started meeting with all these successful family offices here in Kansas City, yeah, they might be doing venture capital and tech stuff now, but guess what? They all got 2,000, 3,000 multifamily units that just provides cash flow on a regular basis. So that's what allows them to go play in the riskier space. And so started to see these common themes, right? And that's really what helped me kind of say, look, if I'm going to get into a business and I'm going to start a business, I want to be able to be investing at the same time. And the syndication business, if done right, can allow you to do both of those at the same time.
Absolutely. Absolutely. So let's talk about finding deals, because right now in this current market, finding deals is tough. We talked about that in the green room, right? It's like it sounds to me like since we last spoke, it's been a couple of years, I think. That you were doing multifamily, I was doing multifamily. We're still doing multifamily, but now we're actually doing more development and we're doing net lease too. But it sounds like you've moved on to not only do multifamily, but also sounds like mobile home parks and some other assets, shopping malls and other and commercial stuff. So let's talk a little bit about finding deals though, all right? Because I think that for many folks out there, that's probably one of the biggest hangups these days is finding the right deal. So how do you know how do you know that when I'm assuming people send deals your way, perhaps, how do you know you actually have a deal? Like, how do you know? Hey, Augustino here, and I would love to connect directly with you. Text the word books to 844-428-1344 to receive weekly book recommendations from me.
Yeah. Well, early on it was, okay, well, one of the principals has to underwrite the deal and then we have to go to investment committee and do this whole thing. Well, what we've done now is, since we are trying to venture out more outside of just the Midwest, is we have an outsourced kind of underwriting team. So basically we have trained this team to be able to aggregate all of the data, pull all of the rent comps and put them into our model, right? So after that's done, then we have it go to our analyst desk. And then our analyst fine tunes that opportunity. If it passes muster, then it comes to investment committee where the three principals are actually going to go through the project together. And so we've got a pretty robust system, I would say. We can get through a lot of deals across the country now, which is great. Had to get into Yardi, had to get into CoStar and buy all the systems and all of that. So it's not cheap to do this. But at the end of the day, we can sit there and evaluate a deal for an hour and a half. And I come back to it and I say, look, well, if this is a multifamily deal, what's the in-place, rents? And if it's $750, usually we can pay between $65,000 and $75,000 a door for it. So it kind of goes back to the 1% price to rent ratio right now in today's market. Not always, but most of the time it does. We in the Midwest, as you know, we're not seeing 17% year over year rent increases on the multifamily side. It was simply, for the last 2 years or year over year, last 12 months, was 7.2% here in Kansas City. That's great. That's great. That's fantastic. But we're not going to keep up with Phoenix, Arizona, or Dallas, Fort Worth area. And so being able to make sure that our underwriting, criteria stay the same no matter what's going on in the macroeconomic environment, that's going to create margin of safety for us on the going in, price per door, which is extremely important, I think, in today's market. And so for us, I think that having a pretty good system to be able to underwrite deals, but also sticking to your investment criteria and not allowing whatever's going on out there just because you want to get a deal, trying to make a deal work. Like, I have so many folks that will send me a project and they're like, hey, we had to underwrite to the purchase price. And I'm like, no, I don't underwrite to the whisper price. I underwrite the deal to what we can pay. And if we're off, which we usually are 25, 35, 40%, it is what it is. We decide if we're going to make an LOI at that time, but we don't underwrite to the whisper price, so I think that that's one thing that, a lot of newer investors have a hard time with was, trying to build relationships with brokers in a market that's extremely competitive and more capital has been flowing into this asset class than ever before is a very difficult time. You have to think about Charlie Munger and the cognitive biases that you have to make sure you understand. Your investors are basically betting on you as knowing what you're doing, right? And so if you go buy a deal and you overpay, you're going to be in a bad position. Now, the last 24 months, if you bought a deal, you're probably in an okay position, because of what we've seen go on. But, that's not going to last. You have to understand the fundamentals, the underlying economic trends that are happening, and that we were in a time for the last 25 months or so that, it was unprecedented. There was more capital printed, more money dollars, from the Federal Reserve printed into the economy than ever before. I mean, that's an artificial kind of environment that we're in. And so, we really just go back to intrinsic value. What is the intrinsic value of the cash flows that the property is currently, providing for the buyer, and then trying to value those and figuring out what they are on a conservative basis. And the last 8 months, we've only bought one multifamily deal that fit that criteria. So that's got us looking into other asset classes that maybe aren't as competitive, neighborhood retail shopping centers, and then development. When the stabilized yield on cost for a 1970s product is the same, so 6.25% here in Kansas City, as a new development 2023 product that I can get a GMAX contract and bonded, what am I going to do? I'm going to go build 2023 new product. Why would I take the risk to go buy a 1970s value add deal in a bad area with the same stabilized yield on cost? This might be a light bulb moment for the listeners. There was a time when value add deals were higher cap rates than stabilized deals. There was a time, I have to realize that that time is not right now. But there's a lot of people that are entering in the marketplace that have never seen that before, and so you're paying for a lot of that value add up front, which you're not going to be able to capitalize on the back end.
Yeah, it's something to point out too. It's like here in the Midwest, Kansas City, Cleveland, Cincinnati, some of these Midwest markets, these are solid cash flow markets. And you pointed this out a second ago, and I think it needs to be reiterated, is that there are two primary types of markets. You have the cash flow markets and depreciation markets, where this is a cash flow market here in Cleveland. Kansas City is a cash flow market. That means that you can buy the asset, it'll cash flow. Will it have appreciation? Yes. But if I had to guess, the way that you're underwriting stuff is how we do it too. You don't count on these giant appreciation jumps over a short amount of time, right? You just don't count on it. I would guess, right? You don't do that.
No. I mean, the cap rates raise during your hold period. They don't stay the same, and they don't go down. So yes, 100%.
This and meanwhile, in places like Florida, where Florida at one point was a cash flow market, people don't even realize that. 15 years ago, nobody wanted to be in Florida, which is kind of crazy when you think about it, right?
Yep.
But now everybody's moving down there, and they're building these beautiful skyscrapers, all this other stuff, and tremendously expensive. And a lot of these guys are getting into those deals where the rents are fairly low. We talked about that in the green room too. And they're praying that in 24 months that the cost per unit will double. It's like, praying is not a strategy, guys. I'm not poo-pooing on appreciation markets, but to your point, where you have to now consider the market has shifted. There's a whole lot of extra cash sitting on the sidelines, but there's also a whole lot more cash available because of all the money that's been printed. And it's not been absorbed. It's like all we did, and I don't want to turn this into a political scenario here, but all we did was take all this cash and offshore it. That's what we did, right? We're sending money away to these different places. That's not a coincidence. That's because we have to offshore our inflation. Eventually that money is going to come back home. And when it does, it's not going to be good for those guys that are using praying as a strategy to get out of a deal. It's crazy.
That's right.
It's crazy.
And you just go back to what Buffett always says, what the wise man does in the beginning, the fool does in the end. And if you look at business cycles, you look at credit cycles, we are nearing the end of those cycles on the credit side. And so that is what impacts the real estate investing space so much. The biggest piece of your capital stack is your debt. And so you have to realize, yeah, sure, interest rates go up, cap rates may go up. They don't move in lockstep, but they do kind of correlate together. So understanding that, but a bigger kind of variable is the capital flows into commercial real estate. And as other ventures like the stock market and other bond markets, they aren't as, exciting for people, and they don't feel as safe. Guess what? They flock to hard assets and tangible assets. And so we're still seeing a lot of that capital chasing yield in the commercial real estate space. So just always remember that what the wise man does in the beginning, the fool does in the end. And I think it's really important right now to be a prudent investor in these projects. Just because you have money, just because you have access to money, doesn't mean every deal that's backed by multifamily property is a good one. And so understanding that intrinsic value and differentiating yourself between a value investor and a growth investor, I think is extremely important. And I would say that here in the Midwest, and our thesis has relied for us to be on the value side of things. And, I think that I'll just give a quick example here. 6 months ago, we were working on a multifamily project in Des Moines, Iowa. And we finally got this thing closed in March or so. And at the end of the day, I put 10-year fixed rate interest rate on this project. It was 10-year fixed at 3.6%. And, 2 months later, we're where we're at, and you can't even get debt anywhere close to that. And so people are like, my gosh, what did you see? How did you time that? I didn't. It just stuck to the same criteria that we had in the past. And one book that I would say that really helped me with this thesis is Sam Zell's book, Am I Being Too Subtle? If anybody hasn't read that book, Sam Zell was he is the largest owner of manufactured housing communities, but he sold his equity office group to Blackstone. He sold multifamily and he's kind of the modern day man of real estate investment trusts. And go and read his investment thesis. It's very similar to what we're talking about here. And when the market is frothy and when there's a lot of capital chasing, guess what he did? He set up an operational company to be able to take on distressed assets. And he is famed as kind of this guy that can time the markets. And I was listening to him on a podcast this morning. He didn't time anything. All he did was look at supply and demand and make good bets and be operationally sound. And he didn't get into any deal that he didn't think he could manage. And that relied very well for him. And he sold all of his office properties in 2007, I believe, to Blackstone. 2007. So he didn't time these markets. He just made good investment bets because he had good criteria set up. He looked at the fundamentals and didn't get too big for his britches. I mean, he still shows up to, all of his meetings on his motorcycle with a cigarette in his mouth, with a leather jacket on. So I think we just have to remember all of these things. All this stuff has happened before. We can go back into history and look at it. It's a good time to be conservative, to be prudent, and to make sure you're betting on, really good intrinsically valued properties.
Yeah, and also I think everything you just said is true, and also stay active. I mean, I think there's a lot of guys that they get into this business and then they just sit by the sidelines and they wait. They're waiting for something. And I think that there's deals all the time. You just have to keep your eyes open for those deals. There's always an opportunity. There's always an opportunity.
Great segue into I think, how do you find opportunities, right? I think
yes.
So I think that this is a great segue into this second piece of this question was, okay, well, where do you find projects, right? Well, I think you first have to take kind of the modern day sales approach, which is get your list put together, right? So you understand the markets that you're in, you get the list of the properties that you're interested in. If it's 50 units and above, great, do that. If it's high rises, fantastic, but really hone in on your list. And then you get your list in your markets that you're interested in. You see what the available market is to you, okay? And then you pull data from CoStar or Reonomy or Yardi, and you figure out who owns those properties, okay? And you're going to start to see themes. There's 90% of multifamily projects above 50 units have more than one owner, like their property that they own more than one property. Okay. So it's mostly in this space, private equity businesses or larger investment groups. So what I tried to do was, okay, where are these properties in the life cycle? When did they purchase them? Are they in a fund? Because you can get that data too. You can see if they're in a fund. And then you try to start making relationships with those people that own more property. So I started with saying, okay, this group owns 3,000 units in Kansas City. Who can I talk to at the company? They have different properties and different funds and different life cycles. So, the way that we were able to buy 426 units is we found one of these funds and they were, cycling out of, 426. It was 3 properties here in Kansas City. And they said, look, these are kind of at the end of the life cycle. We have other deals, sure, but these are the 3 that we want to sell right now. Fantastic. Let's execute on those. And so I took it from that approach. The second part is, okay, if you're looking at 50 units or below, you really have to start just picking up the phone. So we make over 100 phone calls per day to property owners. This is on the brokerage side, but also, brings a lot of deals on the private equity side as well. And the opportunity here is, okay, the biggest thing that I hear is, Logan, what am I going to do if I sell you this property, right? So you have 2 things going against you here. First one is, previously, you could just call a broker and get 35% more than what I was willing to pay. So, that's a hard pitch. You're not going to find a lot of owners that won't just call the brokerage shop and take it to them. So, that's just arbitrage. That's just loss to lease. That's just, you're just going to have a certain amount that you're just not going to win. But the second part is, okay, if they're not going to go to a broker and they're willing to work with you, you have to have something for them to trade into. And so what we created was a transformational exit strategy, which basically is a 45-minute meeting with a property owner to say, what are your goals? What are you trying to accomplish? Because I hear a lot, Logan, I'm managing this thing. I'm 65 years old. I'm managing this thing. It's the last thing I'm doing, but I'm a grandpa or I'm a grandma now, and I'd like to spend more time with my grandkids or this. And so you have to really understand what their goals are. So if they're going to do a 1031 exchange, then you say, okay, well, maybe there's other opportunities for you, either a tenancy in common where you can do a 1031 exchange with other people and not have to manage the asset. Or maybe we go from multifamily to a triple net lease shopping center where it's much easier to manage. Or maybe we get you a great property manager and get you into a class B plus property, not a class C minus property, where it's much easier to manage and you can get somebody that you can trust to actually manage your property. Or, call FTW and say, hey, we would like you to manage it. We would like you to do all the asset management. We still want to be the owner. And so you have a privately held account kind of an asset management model as well. And so being able to go through this with these property owners and say, look, we can help you. You just got to know what your goals are. We can help you in one of these different options. I didn't even mention DSTs, both options, right? Delaware Statutory Trust and Deferred Sales Trust. Those are other opportunities as well. I didn't even mention Opportunity Zone projects. Those are other opportunities that people can, and most of these people don't even know about these options. And so we've created a transformational exit strategy. We have documentation around all of this. We have these meetings, and that sets us apart from just the other brokerage shop because we're actually trying to understand what they're trying to accomplish. And then we line that up before they're willing to let buyers come through and make offers on their property. So that's been really beneficial. We have 4 or 5 people going through that process right now, which is going to create, I think, a lot of business for us. And so just trying to hear those pain points, solve those, and bring multiple options and let them make those choices has been really helpful to help these, new deals come to our kind of exchange marketplace that we've created.
Yeah, well, I mean, you're creating the opportunity is what you're doing, right?
That's right.
Where before you could easily call a broker up, and then brokers would typically do the hustle needed to get the investors to move off and sell an asset. Nowadays, everybody's afraid to sell. Today,
Yeah.
people are afraid to sell. Like you said, they're afraid to take this equity and move it into another asset because there may not be an asset available. So what you're doing is you're solving that problem by, like you said, creating this exchange. So it sounds to me like a great deal more effort on your part to put all this stuff together. But you're presenting a solution, which is phenomenal.
It's a win-win because the sellers typically don't know where to put their money, so we bring those options for them. And then the buyers who are typically completing or trying to complete a 1031 exchange, they don't have to compete with 50 other buyers, so they have some sort of surety to getting to close, and they have options. And so it's a win-win because they're on a timeline. The seller already knows what they're going to trade into. You pair them up together, you work the whole process. Yeah, sure, it's a lot more work, but you create win-win on both sides of it, and it's been receptive in the marketplace quite a bit. So then, obviously you have your modern sales approach where you just got to have your list. Then you got to get creative. I think right now, everybody, you just can't do what everybody's doing. You have to set yourself apart. And so having a transformational exit strategy, having something that, sounds different and having options because you've already thought through what those pain points are going to be for a seller means the world to them. I mean, it really does. And then you're willing to spend time with them. So again, you're not going to get everybody to do that, and that's okay, especially if it's a fund like we bought from. Those guys don't need a transformational exit strategy, right? They're transitioning out of a fund. They got their IRR for their investors. They're paying their taxes and moving on. But I wouldn't have had that opportunity if I hadn't identified that they owned those properties, right? So, I think that there is some science to it, but then you got to get creative and you got to stand away from just all of the other competition in the marketplace, and you got to be willing to do different things in today's competitive landscape. And that's, both putting those two together have created opportunities for our investors and for ourselves.
Yeah. Now, here's the thing. I think that these days, especially, people are still pricing their stuff the way they might have priced it 6-8 months ago, right? They're still stuck in the fact that, oh yeah, you can get debt for 3.5. Not anymore. You're not. There's no way that's happening, right? So how do you identify some of those aggressive underwritings or even ensure the accuracy of the financial statements and other documents that people might send over to you? Like, how do you know? How do you figure that out?
Yeah, good point. There's definitely still kind of a big gap between the bid ask, kind of situation that we're seeing right now. So, I think the biggest thing for sellers is, hey, we've got a couple banks that already underwrote this deal, and we're at the mercy of an appraisal. And so, yeah, sure, we had these appraisals going on, the last 12 to 15 months, but now, banks are saying, hey, we're going to get a little more conservative, or, maybe we're underwriting to a higher debt service coverage ratio, or, maybe the strength of the borrower needs to be a little bit stronger. And so using that tangible data from financing institutions to go to sellers and say, look, I know that this is what it's been the last 24, 36 months. It could get worse. So right now might be the best time before it does get worse and interest rates continue to rise. So to capitalize, what do you need to see on your properties? We can't compare it to the last 24 months because this thing is transitioning and changing so fast. Here's the data from financing institutions that are going to finance your property for a buyer. Here's what they're telling us. What is it that you need to get out of your property? And again, you're going to have some arbitrage. Some people are just going to say, you know what? I'm not gonna go down this route right now. I'm just gonna hold on to it, or I'm gonna take it to a brokerage shop who is telling me something different. But you will find some folks that are like, okay, no, that makes sense. And I understand that. And so then they have to just kind of reset their expectations with their own, properties. And that just, that's a little bit more of the art piece of it that the brokerage kind of community that we have here at Exchange CRE has to work through with these property owners, because I'm not really in the business of telling somebody that we can do something. And then we can't do it. And I know that we can't do it just to get kind of a listing or a commission agreement or something like that. That just doesn't, it's a small world here in Kansas City. And if you start doing that, and you don't perform, you're going to get blacklisted pretty quickly. So just try to be real
too.
Yeah, it's unethical.
Yeah.
And so, I have brokers reach out to me all the time about our properties, telling me that, hey, I'll bring you this offer and that offer. And I'm like, I just don't see that happening in today's marketplace. I know, because I'm on the other side of it. So, people aren't typically, super dumb if they're buying a $50 million portfolio. It's like something's going to come up and we're going to spend 6 months going through this whole thing, and then it's going to fall apart, and then nobody's going to be happy. And so I think just being real, setting expectations the right way up front with sellers and saying, this is what we can do. Somebody might tell you something different, but here's why I think we can do it. And then having tangible data that's kind of objective third parties, either that be from an appraiser or an actual bank or financing institution, to get a second opinion on something, and say, look, guys, like, we had like a $30 million industrial deal earlier this year, and it was looking great. We were hoping to close, and then the debt markets went crazy. And guess what? That deal busted because of the debt service coverage ratio on it. So at the end of the day, I know the kind of the snags that are going to happen in these transactions. Have been through close to $450 million worth of transactions now. And there's not that much that surprises me. Still get surprised, but there's enough things that you can kind of identify and say, let's get ahead of these, and bringing that to the seller to say, hey, we're trying to mitigate your risk. We're trying to give you as much time back to yourself as possible. We're not trying to spin your wheels here. And that's why we're bringing it up right now, and having those expectations set works with quite a few people.
Something that I find is happening these days is, because the market has shifted so much, I'm hearing, I don't actually do this, but I'm hearing there's a lot of retrading that's taking place too. Meaning we got it under contract over here at, $30 million. And then by the time you get, you have, your due diligence, maybe you have an extension built in there, and you're just about to close, that $30 million deal is now worth $28 million because the lender changed the debt amount or whatever, right? How are you retrading stuff? Like, are you guys doing that, or do you try to find legitimate reasons to retrade, or what's your general rule of thumb when it comes to that? And what are you seeing?
On the brokerage side, we're trying to be very conservative. So when the buyer sends us one of the qualifications of working through the process with Exchange is, I need to see your underwriting. And if you still have 4% interest rate on your debt, I'm going to send it back to you at 5.5 to 5.75 and say, hey, you know what? If this is the one thing that is making this deal work for you, that's not going to work. And if you have 36 months of interest only in there, I'm going to put it down to 12 months. And we're going to stress test this thing at the beginning. If that doesn't work for you, hey, that's fine. But like, we're not going to we'll still put your offer in front of the seller because we have to, but we're going to explain, that these are the things that you're assuming. So I think that's on the brokerage side. In regards to the private equity side, when we're actually acquiring something, I get term sheets back during the due diligence process at 475 or 495, but in our pro formas, it's 525 to 550. So we're not going to retrade unless something just falls out of the bottom of the market, like it did in March of 2020 when I had $30 million of shopping centers under contract and the economy was shutting down. Like I had to drop those deals because I just didn't know what was going to happen to retail at that time. But in regards to going forward right now, it's like, look, if it's debt, I'm pretty confident we know where it's going to come in at. So, my analyst is from a bank, so we're pretty conservative on that front. It just comes down to like environmental or survey issues or things like that we retrade on. We typically don't retrade on price unless, the financials don't meet up with the bank reconciliations and maybe something was actually misrepresented and it was, not true. Then we'll definitely retrade. But in regards to debt, unless something falls out of the market, we're not typically doing that. And what I'll tell you this on the brokerage side, I have my own podcast, and we were interviewing a top brokerage client or service firm here in Kansas City. They have 14,000 units listed across 32 states. So he has some really great data. He said not a lot of retrading going on, but what he did say was maybe 6 weeks ago, we had 12 different parties at the whisper price. Now we have 6. And so I haven't seen a ton of the retrades yet, but we have seen more parties fall out of actually competing for those prices at those prices. So I think that's one thing that I'm definitely going to keep my eye on and try to get some anecdotal data from groups that are working in the industry. But in regards to retrades, just depending on when you went under contract, sure, you might be in a tough position and you might have to retrade because of something like that, right? I mean, your proceeds may go down, the deal may not work. It was probably already thin to begin with. And so, yeah, I mean, if you have hard earnest money deposit down and you're a sponsor and things change on the debt side of the business for you, either you got to eat that or you got to have some sort of plan B to figure that out. But I'm guessing there's going to be a lot more retrading, especially with deals that went under contract 60, 75 days ago, and now we're trying to get to close. I can see why that would happen.
Yeah. So where do you see the market headed in the next 6, 8, 12 months? Like, where do you see that? So I think now that we've gone through some crazy times over the last 6 months, what do you think the next 12 months holds?
Well, definitely watching on a quarterly basis the capital flow. So the percentage of GDP that is originated for new mortgage debt. That's one marker that I really like to watch. And Dr. Peter Linneman was the Wharton professor of real estate, and he ran that school there. And he puts out a quarterly report. So I follow him very closely in regards to that and seeing what that percentage of GDP is and if it's increasing or not. The other thing that I track pretty closely is, Green Street's property price index, and it's flatlined. And so from April of 2020 to October, well, really September of 2020, there was a big decline in the multifamily space. Then it skyrocketed, right? And now we're kind of flatlining. And so I think that it is starting to cool off in regards to not increasing, but we're still at extremely elevated levels. So until I see their next report that starts to see, prices go back down, I'm thinking that there's still quite a bit of capital chasing these deals. And so those are kind of the two markers that I'm watching to see, what opportunities. I pair that with a lot of anecdotal data here that we get here in the Midwest, just in general, from one, talking to property owners, two, putting offers in and talking to brokers as well. So we're tracking that as well. But and on that front, I have not seen deals that still pencil, in regards to that. So I think it's still going to be hot for a while. I think that we're back to interest rates back in 2018, 2019. We'll see what happens to the economy. I just sat in at a CEO's group. ITR Economics came and presented, and they were pretty bullish on the United States. They said, don't bet against the United States. They don't see a huge recession kind of happening until 2025, where a recession might happen, and then a big depression actually in 2030. Those are big calls. I don't know if I agree with them or not. I'm just trying to stay pretty granular with where debt is right now and where we need to be at on prices, and then looking at different opportunities in different asset classes. I mean, shopping centers are a great example. Like I mentioned, back in March of 2020, I was pretty bullish on these, and then the economy shut down. So, now I have 25 months of data to say, well, how did they perform? It turns out a lot of more essential businesses, and they did pretty well. But guess what? A lot of those smaller businesses that were a little weaker from the get-go, they kind of funneled out. And so you're actually seeing shopping centers, neighborhood retail shopping centers, 25,000 to 75,000 square feet, located in great locations, perform very well because some of those smaller, weaker businesses kind of funneled out, and newer, better businesses have come back in. So I think property owners have been a little more selective to who's going to actually come into their shopping centers, because they have tenant and landlord contributions that they have to make, and they want people to pay their rent and be able to pay their rent. So I think that's really important. So looking at different opportunities there, I'm still very bullish on multifamily. I think there is a huge supply and demand imbalance. I think we have a long ways to go to catch up with that. So then it becomes, where do you play at? And I think the affordable space is great. I think the development space is wonderful, but it's just very difficult to find those deals. And so you just have to keep the velocity of deals very strong. You have to build these relationships with sellers and with brokers, because there will be a time where there's not 50 people bidding on one deal in Kansas City, and they're going to call you because, you stayed in touch with them and you have a relationship with them. And guess what? You're going to get opportunities if you just stay in the game right now. That's kind of my outlook.
That's right. You got to stay active. Yeah.
That's right.
So good. So we covered a lot of stuff here today. What sort of bulletproof advice would you have to offer for someone listening right now?
I would just say be quick, but don't hurry. I think that's really important advice. I think that, you can see all these people being successful, but just remember, there are so many horror stories that you don't hear about on these podcasts and on, in real estate deals. There's just as many of those as there are, hey, this was fantastic and wonderful. So I think it's really important to be quick, but don't hurry. Look for different alternative asset classes, maybe than just other stocks and bonds. Tangible, cash flowing real estate is a fantastic place to be. And then vet the heck out of your operators. And so if they're running your deal that you're in, vet the heck out of them. And if they're not willing to spend time with you and answer the tough questions, then it's probably not the right opportunity for you. Because, like we both said on this show today, I think that there's tougher times ahead. And so if so, then, tough operators are going to be the ones that are able to actually come out ahead. And so I think that's really important. Vet your operators, be quick, but don't hurry. And don't be, don't hurry to get into just any deal. Vet the heck out of your operators, and they should be able to spend time with you, and you'll get a gut check feeling. I think that's really great. Don't bet on huge rent increases. Again, I think that's going to be, something that's going to fall off a little bit, but I may be a contrarian in regards to that. I think that there's certain markets that are going to do well. Analyze the heck out of the data that you have for the last 24 months. It's all out there now. RealPage, CoStar, Yardi, it's all out there. You can get into it. Be an informed investor. That would be my advice, and be quick, but don't hurry.
Right. Love it. All right, guys, if you want to reach out to Logan, reach him via his website at livefreeinvestments.com. Hope you got some insight on how to find good deals, how to build those relationships, and really the importance of being prudent when you are looking at deals. Okay, that's something that both we Logan and I totally agree on. It's that's what's really kept us safe. It's going to take us all the way through to see the life cycle of all these assets perform. It's 100%. Thanks for tuning in, guys, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.